that, ladies and gentlemen, there comes a moment in history when the ground beneath our feet shifts, not because of an earthquake, but because of a choice, a decision, a stand taken that echoes across oceans. And right now, that tremor is shaking Wall Street, that America's stock market has taken a sharp dive, rattled by India's bold move in the tariff war. That this isn't just about numbers on a screen or red arrows on a chart. This is about pride, sovereignty, and the price of playing the long game in a world addicted to quick wins. That India's decisive action in the tariff war was not a sudden impulse, but a calculated and deliberate move born out of years of economic observation, that political will and national pride. For too long, that trade negotiations between powerful nations and developing economies followed a predictable pattern. The stronger economy dictated terms, and the weaker one adjusted in the hope of gaining favor or avoiding conflict. India, however, chose to disrupt that pattern, that when faced with tariff imbalances and policies that threatened its economic sovereignty, it made a conscious decision to stand firm, that even knowing that such a move could trigger backlash from one of the world's largest economies, that this was not about picking a fight for the sake of confrontation. It was about asserting a fundamental right to fair and reciprocal trade, that by imposing counter tariffs and refusing to yield under pressure, that India signaled to the world that it would no longer accept a subordinate role in global economic dynamics. That this action was not just a matter of economics. It was about redefining India's position in the world order, that showing that it is capable of defending its interests without fear of short-term consequences, that the decisiveness came from understanding the long-term benefits of self-reliance and the need to protect domestic industries from policies that could undermine them. That critics warned of possible market instability, trade disruptions, and diplomatic strain, but the decision makers in India viewed these as temporary costs compared to the lasting advantage of being seen as a nation that stands its ground. That the move was also a message to other countries that partnerships with India must be built on equality and mutual benefit, that not on pressure tactics or economic coercion. In an interconnected world, that such an act carries more weight than a simple policy change. It becomes a symbol of national willpower. That the firmness with which India acted demonstrated a shift in global power narratives. That proving that the days when only certain nations could dictate trade terms are fading. By taking this stand, India didn't just defend its economic interests, that it inspired other nations to reassess their own trade strategies and consider whether they too could resist unfair arrangements. In the eyes of many, this was not just a policy decision, but a defining moment in India's journey toward being recognized as a truly independent economic power. That the market crash is not just financial because its impact goes far beyond the numbers flashing red on trading screens or the value wiped out from stock portfolios. That at the surface, it appears as a loss in capital, a decline in investor confidence, and a disruption in economic activity. But underneath lies a deeper shift, one that touches geopolitics, national pride, and the very relationships between nations. When markets crash in response to a political or economic decision, it reveals a fundamental truth. Finance is intertwined with human perception, trust and power dynamics. In this case, the drop was triggered not by poor earnings or a sudden global recession, but by a clash of will between two major nations. This means the crash is as much about the story people are telling themselves as it is about actual numbers. Investors read the situation as a signal of instability. Businesses see it as a warning about future trade restrictions. And policymakers interpret it as a test of resilience. It also serves as a mirror reflecting the growing independence of nations like India which refuse to accept terms that compromise their sovereignty. The fall in the market, therefore, that becomes a symbol of a changing global order where emerging powers can stand up to economic giants and force a rethinking of traditional power structures. Beyond the financial sector, this kind of crash can influence public sentiment shifting how citizens view their government's resolve and priorities. In some cases, it can strengthen national unity with people rallying behind a decision that may hurt in the short term, but promises long-term independence. In others, it can create political pressure to back down, revealing the delicate balance between economic pain and political courage. Moreover, the psychological impact of such a crash can outlast the immediate financial losses. It shapes how future negotiations are approached, how trade alliances are formed, and how nations measure risk when asserting their interests. It is also a reminder that in today's interconnected world, markets respond not just to economic data, but to every signal of tension, ambition, and resolve. This is why calling it merely a financial event would be an oversimplification, because in reality, it is a cultural, political, and strategic moment disguised as a line graph moving sharply downward. It changes perceptions, recalibrates relationships, and sets the tone for the battles and collaborations that follow. India refused to bow to external pressure because it recognized that the cost of surrendering in principle would be far greater than the economic or political risks of standing firm. In the world of global trade and diplomacy, there is often an expectation that larger powers can influence smaller or emerging nations into compliance through a mix of economic incentives, political leverage, and even subtle threats. For decades, many nations have reluctantly followed this pattern, prioritizing short-term gains or avoiding confrontation at the expense of long-term independence. India, however, chose a different path, faced with mounting pressure to adjust its policies in favor of a more dominant economic player. It made the deliberate choice to protect its own sovereignty and defend its right to fair trade. This was not a reaction born of stubbornness, but of strategic calculation, a recognition that bending in this moment would set a precedent that could undermine its position in future negotiations. By rejecting demands that conflicted with its national interests, India sent a clear message its policies and decisions would be shaped by its own priorities, not dictated by external forces. The refusal also reflected a growing confidence in India's economic and political strength, as well as its ability to withstand potential consequences such as sanctions, reduced market access, or diplomatic strain. It was an assertion that India's voice matters on the global stage, and that it will not compromise its dignity for the sake of avoiding temporary discomfort. This stance resonated deeply with its citizens, reinforcing a sense of pride and self-reliance. It also signaled to other nations that India is prepared to engage in partnerships built on equality rather than submission. The move was as much about shaping perception as it was about securing tangible benefits. It positioned India as a nation capable of resisting pressure without isolating itself from the world. In the broader context, this decision is part of a larger shift in the global balance of power, where emerging economies are more willing to challenge established norms and refuse to accept a secondary role in international affairs. India's choice in this instance is a declaration that while it values cooperation, it will not trade away its independence for convenience. This act of standing firm will likely influence how other countries approach India in the future, that knowing that pressure alone will not secure compliance. It is a reminder that true strength lies not in avoiding conflict at all costs, but in having the resolve to endure it when necessary to protect what matters most. That the future depends on leadership choices, because moments of crisis or change are shaped not only by external circumstances, but by the vision, courage, and decision-making of those in positions of power. Leaders set the tone for how nations, businesses, and communities respond to challenges, and their actions can either escalate tensions or pave the way for solutions. In the context of an economic or geopolitical standoff, that leadership becomes the deciding factor in whether the situation moves toward cooperation or confrontation. That a leader who acts with foresight understands that immediate reactions must be balanced with long-term consequences. Every statement, every policy, and every negotiation sends ripples through markets, influences public sentiment, and shapes the perception of strength or weakness on the global stage. The ability to weigh these factors and still make decisions that prioritize national interests without closing the door to future dialogue is a rare and critical skill. In moments like a tariff war or a market crash, there is a temptation to respond emotionally, to match pressure with greater pressure, to protect pride at the cost of progress, or to seek quick wins that appease the public in the short term. But history has shown that lasting stability and respect are earned when leaders demonstrate restraint where necessary, firmness where required, and creativity in finding solutions that serve multiple interests. Leadership choices also determine the narrative that will define a nation's position in the world for years to come. A leader who navigates a crisis with wisdom can turn a moment of uncertainty into a turning point for growth, innovation, and stronger alliances. On the other hand, poor decisions rooted in ego or short-sightedness can deepen divisions, erode trust, and lock nations into cycles of retaliation that weaken everyone involved. The responsibility is immense because these choices impact not only the current generation, but also the opportunities and freedoms of those yet to come. Citizens look to leaders not just for policies, but for a sense of direction, unity, and confidence that their interests are being safeguarded. International partners watch closely to judge whether collaboration is possible or whether conflict is inevitable. Even markets, though driven by numbers, are influenced by the tone and decisiveness of leadership in uncertain times. In the end, the course of events often hinges less on the crisis itself and more on how leaders choose to respond to it. The paths they take can turn potential disasters into opportunities for reform and strength, or they can transform manageable disputes into lasting fractures. Market downturns can be turning points because they often serve as moments of reckoning, forcing nations, businesses, and individuals to reassess priorities, strategies, and resilience, while a sudden drop in market value can initially create fear and uncertainty. It also strips away illusions and exposes underlying weaknesses that may have been overlooked during periods of growth. These downturns compel decision makers to confront hard truths about structural vulnerabilities, over-reliance on certain markets, or complacency in economic planning. In doing so, they create the opportunity to rebuild on stronger, more sustainable foundations. A downturn challenges leaders to think creatively, to find solutions that not only restore stability, but also prepare for future shocks. It can be the catalyst for policy reforms, diversification of trade relationships, and investments in industries that are less vulnerable to external pressures. For investors and entrepreneurs, that it can open the door to buying undervalued assets, innovating in response to changing conditions, and entering markets that others are too cautious to explore. On a national level, a market crash can push governments to reduce dependency on a single partner or sector, encouraging self-reliance and fostering industries that build long-term strength. The emotional impact of a downturn also plays a role in its transformative potential. Fear and loss can ignite a determination to avoid repeating past mistakes, motivating both leaders and citizens to become more proactive. Disciplined and forward-thinking, historically, the many economic recoveries have not only restored previous levels of prosperity, but have surpassed them because the crisis spurred a wave of innovation, efficiency and strategic cooperation. Even in geopolitics, a downturn linked to a dispute can shift the balance of negotiations, encouraging parties to seek compromise or redefine the terms of engagement to avoid future instability. The key lies in perspective, whether a downturn is viewed solely as a setback or as a pivotal moment to pivot toward a better trajectory. Those who approach it with adaptability and vision can turn short-term loss into long-term gain. It is in these moments when the usual patterns are disrupted, that new opportunities emerge for those willing to act decisively and thoughtfully.